Hello, this is Jordan, and this video is being recorded on the afternoon of Monday, November 20th, 2023. Thank you so much for tuning in. In this video, I'm going to talk about the macro situation right now, the macro market situation, and the setup over the coming months or coming quarters. And it really comes down to a question of recession, stagflation, or soft landing. And starting off, the market right now is discounting a soft landing. So what we've seen in recent days, not a huge surprise, but we had the low CPI print. The effect of that, or the reaction to that, is the market is discounting disinflation moving forward. So that means a lower rate of inflation. That is bullish for the stock market. That's best for the stock market. So the market right now senses a soft landing. It's not discounting a recession or stagflation, at least not yet. And so getting into what some of the markets and assets are doing, we can look here at this chart. And I know this is kind of difficult to look at because I have so many things here with the bond yields, S&P, dollar, gold versus this. But let's focus on the highlighted areas. And so these show the strong moves higher in long-term bond yields. So we have the 10-year yield here. This was a period where we saw a big increase in bond yields. That was negative for the stock market. This period right here, a much shorter period, but you had yields. You had the 10-year yield going from somewhere in the mid-threes up to almost 5%. Stock market was selling off at the same time. And during those periods, for the most part, you had dollar strength. And towards the end of that last period, you were getting close to the recession signal, where you have the yield curve, that's the 10-year minus the 2-year yield, or that's the most popular metric. When that is inverted and then it rises above zero, so a move like that, that would indicate almost an imminent recession or an imminent threat of recession. And so this had been moving higher, getting pretty close to going above zero, but no dice, at least not yet. And so now that has come down. It's flattening again, and it's still inverted in negative territory. So until that happens, until that goes above zero, it's not necessarily bullish for precious metals. And so you have the 10-year yield here, peaked at 5%. It's coming off, and at the same time, the dollar has come off some, and you've got this rebound in the S&P, which of course is negative for gold at the same time. So gold, has rebounded, but it's off the rebound high. Gold in real terms, if we look at gold against foreign currencies, gold against the S&P here, gold in real terms has come down during that period. So if we're thinking about the here and now, the next couple of months, at least into the end of the year, maybe it'll shift when we get into Q1 of next year, but into the end of the year, it looks like this is the macro setup that we have, which is the market is discounting a soft landing. So there's less concern now about stagflation because the 10-year yield is now coming down. The inflation expectations are starting to come down at least a little bit. And again, the market is discounting a soft landing. And so we'll see if the S&P, which is getting closer to that all-time high at the very end of 21, we'll see if the S&P can continue to run and make a new high. And so as long as the stock market is rising, the market's not, obviously, as long as it's rising, it's not sensing that threat of recession. So to me, that's what we're looking at over the next month and a half at least, maybe a little bit longer beyond that, is a soft landing. However, let's zoom in on gold with respect to the stock market and the yield curve, and just talking about recent history and what we can take from that into next year. And so if we go back to 2016, and of course this consolidation here, which you could even include that from 2013. But after the big move up, gold was stuck here. You had the stock market moving to new highs. You didn't have any threat of recession as far as looking at the yield curve. So gold did not make a major bottom until here and then begin that big move up. Because what happened? Well, you had this 20% decline in the S&P. You had the yield curve got really close. I mean, the Fed stopped hiking when the yield curve was getting really close to giving that the recession signal. So you didn't get a full-blown recession signal, but the Fed at that point with, statistical inflation only 1% or 2% or whatever bullshit it was at the time, it was at a level where the Fed was able, they could start cutting rates again. And of course, we know what happened. They cut rates. Gold moved up to here. The stock market recut. Then we had COVID, and that obviously was a huge catalyst for gold. But it was only temporary because you only had this 4-month move. And it's interesting to note, look at where gold peaked. Gold peaked just before the stock market surpassed its COVID high. So the stock market here made a new all-time high, surpassed that COVID high, consolidated for a little bit, and then as it continued higher, gold traded lower. And so gold has been in this long consolidation, a bullish consolidation, even as the stock market has not gotten back to the high yet. And so it would be really negative for gold if the S&P was able to continue higher and make this high. A great, new secular bull market continues. And I mean, that's possible into next year for a little while. But the problem is the yield curve. And so, maybe for the next 2, 3, 4, 5 months, maybe the yield curve can stay here in negative territory. It can, avoid making that recession signal where it goes above zero. But the fact that the curve, I mean, it's already inverted. And after that happens, it's only a matter of time until, it eventually steepens to above zero and you get that recession signal. And so that's why you can't get too bullish on the stock market. Even if the stock market makes a new high here, makes a move like that, it's not going to be sustainable because at some point, at least what I think, in the next year, you're going to see the yield curve steepen to above zero, making that recession signal. And at the same time, I mean, not to babble on and belabor the point, but, the unemployment market is really starting to weaken the jobs market. And so in the next couple months, if that continues to get weaker and we start to see, a tiny amount of jobs being added, once the jobs market and outlook really goes negative, that's when the Fed knows that they're really going to be pressed to cut rates at some point. So that's where we are here and now. Summing it up for this video, the macro market outlook, I think, for the next, at least until the end of the year, looks like it's going to be a soft landing. However, at some point, and I think probably early next year in the first quarter, we could see that, maybe the concern becomes, maybe that morphs into concern over recession versus stagflation. So that's something to keep in mind. But, we're going to, macro-wise, I think we're going to be moving, between these potential outlooks. So soft landing for the next month and a half, but it's probably going to shift after that. Let me know what you think in the comments. Leave a comment. Thank you so much for tuning in. Talk to you guys again in the next video.